Sorry about the technical difficulty before. And this may have been a blessing in disguise, Luca, in the sense that my study really nicely follows from Oscar's, in that I actually look at the competitive consequences of PSD2 and open banking and the way that consumers have been adopting versus not adopting these schemes. Whether these schemes have been successful and what kind of changes they have led to in the market. So without spending too much time at the beginning, the way that I approach this issue is from a platform point of view. And just a quick introduction on how platforms have been entering our lives in various sectors. Here you see some sectoral comparisons of Uber versus BMW, Airbnb versus Marriott, and interestingly, Uber and Airbnb don't own vehicles and properties, so that makes it very interesting to compare. And the reason why platforms have really taken over is, of course, because they sell reductions in transaction costs, and we are able to consume many different services on a platform, which is in particular true in the GAFA or GAFAM, if you want to include Microsoft, which many people do, platforms which have built themselves as infrastructural platforms rather than sectoral platforms. And these platforms actually end up, entering different sectors one by one. And in one of my other studies, I look at how they entered education, healthcare, and finance, and provide a comparison between the entry strategies in these different sectors. The reason why we see these big platforms doing well also is because once they start to get a critical mass, it becomes a winner takes it all, or let's say a virtuous cycle, where due to network externalities, nobody wants to use any other platform. Just like the fax machine has taken over communication for a while, and we didn't have 10 different types of machines for this, but one. Now, the thing that we wanted to look at, and this is the kind of segue into banking, is that incumbents and newborn platforms are usually not on the same boat. So for example, if you look at these GAFA firms, all of these firms, and Apple has reinvented itself, if you will, in the 2000s as a platform firm, all of these firms are digital born or platform business model firms. Whereas if you are an incumbent in a certain sector, you might really struggle in being able to switch to a platform mentality. So given that, we asked ourselves, are incumbents and newborn platforms on the same boat in terms of building a platform and filling it with complementers? In other words, those innovators that sell products and services on your platform and then therefore increase the value of your platform. The particular research, the formal research questions rather, are the following. What opportunities and challenges do incumbents and new players experience in platform formation? And how do these influence their strategic choices in terms of ownership and openness? This study has been, is basically 3 years of data collection with over 100 key stakeholders in the UK and in EU. These are semi-structured interviews, typically 45 minutes to an hour long, with incumbent banks, challenger banks, fintechs, and various regulators and industry experts. So this covers the time leading up to PSD2 and open banking, as well as the first year and a half after PSD2 and open banking, when the market started to change. Now, I'm going to actually use the same slide as Oscar to show the strategic importance of open banking and PSD2, which have been in effect since January 2018. As you see on the left, the only way for us as a customer to access our data and our assets in a bank was through proprietary assets before, right? Proprietary apps before. So this will be the HSBC and Lloyd's and all those apps that belonged to the bank, which meant that practically our data belonged to the bank, although legally it might not have. However, PSD2 and open banking basically say that you don't have to access your data just through these apps. you can give third parties access to this data through APIs, which allows these third parties to work on your data through machine learning, etc., to develop better services, more tailored services. And so you are not then just bound to your primary bank to consume financial services, which is great news. As Oscar also mentioned, this really helps level the competitive field and gives fintechs a chance to come into this market. Without this regulation and without access to data, fintechs would have to depend on customers completely switching banks, but in this scheme, they don't have to. This basically means that I can stay with HSBC, but still try out Monzo or Starling because I can share my data. Now, we looked at what this meant for banking, and in particular, what type of platforms were being formed as a result of this new scheme. And we have seen that there are two different types of platforms coming from two different types of players. The first platform is on the left, the color of money, incumbents, the established banks, trying to build platforms by themselves or trying to buy platforms and using them as if it was theirs through white labeling. And we see on the right, new entrant platforms. These will be the challenger banks, for example, like Monzo and Starling and N26, that come into the market with a full banking license. And they don't want to provide all of the banking services themselves because they feel no need. So they build these Amazon-like marketplaces where you can consume fintech services on top of the N26 platform. When we compare these, we see big differences in terms of platform formation and openness. What does this mean? Platform formation is basically the question of, can I, as an organization, build this platform myself? Do I have the technical and the IT infrastructure, technical capabilities and IT infrastructure and the organization culture, etc., in order to build this kind of platform in banking? And we see that in the case of established banks in the upper path, that the issue of whether they can build this platform or not is a big issue. And the answer is typically no. And platform openness relates to whether, as a firm, once you build a platform, you are willing to bring competing complementers, meaning those that sell services that might compete with your products and services on the platform, just to make the entire platform more attractive. So this will be the equivalent of Amazon providing, just, because of Corona, their own toilet paper, but also selling all the other brands on the platform because, they want to give people a choice, because that increases the total value of the platform rather than just trying to focus on making money themselves. So established banks struggle with building how to build a platform, as well as which complementers to allow, because they have their products and services that they need to still sell. Whereas if you're a challenger bank, then the issue of how to build a platform is not so much of an issue, because you already have the tech, you are digital born, and this is what you do. However, growing that platform is an issue. And how much of it do I offer myself, or do I rely largely on complementers for all those services that I need in order to compete with a large bank? Let's first look at the case of incumbent banks. Now, as Oscar also mentioned, incumbent banks have been, the place where data has stayed, and data previously was not shared. And interviews reveal that incumbents actually see themselves as fortresses, right? That protect your data and your assets. Now, open banking and PSD2 provide a different perspective. If you see those, let's say the windows on that fortress, these windows become the plugs where data now will be siphoned out, right? And this actually provides a scary scenario for banks, because they, at least initially, have felt that they were at the losing end of this regulation, because data is getting out of them. They are not the sole owners or keepers rather of the data. This motivated them to actually look at offering more innovative services in order to compete with the challenger banks, which we will also talk about in a few minutes. However, when they tried to think about how to build a platform themselves and offer it to consumers, what they realized was that first of all, their IT infrastructure was actually not appropriate for this. And the reason is not that, you know, these are old organizations and that their IT is also old, etc. There's a very regulatory specific reason for why IT infrastructure developed in a certain way in these banks. If you look in the picture on the left with the boxes, you see that because of regulation and because of the consequences of not complying with, you know, data protection, etc., every time a bank had to wanted to add a product to their portfolio, whether this is mortgages or credit or international transfer, etc., they had to build a separate IT pillar with the technology of that decade. And they specifically wanted that IT pillar to be isolated from the rest. And the reason for this was in order to make the system resilient and not cause system failures by trying to connect things, right? Because security was the most important thing. Now, what that meant was that they built over decades IT pillars that did not talk to one another and that were very secure, again, mini fortresses within themselves, and that even used different technology and kept data within itself. Now, when you have this IT infrastructure, and when, you know, a bank is largely a firm that works based on technology, like the physical assets are a small part of what's going on, which meant that they put managers on top of these IT pillars and made these profit centers. So this will be, you know, mortgages is run by, you know, is a pillar run by a certain set of people, and loans and, you know, personal SMEs, etc. These are all different pillars. What this means is that the organizational structure then mirrors the IT infrastructure, and the whole thing actually creates a situation where data is nicely kept inside these boxes, and there is then institutional logic that's built on top of that over decades of operating in this way, which is that data is, you know, this is an actual quote from a bank. They say we used to see data as a biohazardous waste that needed to be contained, right? So fear of touching the data for the sake of security was the predominant logic regarding data. Now, on top of this, of course, open banking and PSD2 come, and they realize that the new players in the market, the only way that these guys can make money is by analyzing the data and by offering more tailored services to customers, which makes them wake up and realize that, you know, look, you know, we either have to change this logic, or we need to partner with those that actually work on more innovative things. And as you know, if you're a large organization, trying to reinvent from within is quite difficult. And because of this, and, you know, also in line with the previous presentations here, there was an initiative to partner with some of these fintechs. There, the regulation actually stood in the way to a great degree, though. Although the regulation wanted these collaborations to happen, there was an unevenness in the regulation, in the sense that the regulation, because the regulators were playing catch up, in the sense that they did not know how to regulate the smaller fintechs, but they knew really well how to regulate the big banks, regulators actually went still after the banks, in the sense that if there was something wrong in a collaboration between a big bank and a fintech, the bank had the responsibility to show that it wasn't their fault. So they were guilty until proven innocent, in a sense. And this actually created a situation where the banks greatly lost their incentive to work with fintechs, because the regulatory and compliance consequences of something going wrong were very large for them. In terms of whether they were willing to also work with fintechs in terms of fintechs that worked on competing products to the bank, the idea, and this is again a direct quote from a bank, they said that they didn't want their banking app, say the HSBC or Lloyd's app, etc., to look like NASCAR with all these different logos. And what that means is that they wanted to white label many of the fintechs that they were working with, which of course didn't work very well for these fintechs, because the only way for the consumers to get to know these fintechs and to actually want their services was to have brand recognition. So this was a big issue in the collaboration between banks and fintechs. And as you see on the right, banks were very much left with the idea of, do I actually still try to put my existing products and services on these platforms that I'm trying to build? Or do I completely scratch them, which of course, would create a corporate revolt, because the bank would just then be a backpipe or a dumb pipe, as we say, in that keeps the money and the data, but all the value-adding services would be then provided by fintechs. The banks were not ready to go with this business model. Now, flipping it, what this means for a fintech is that if by any luck you won some bank hackathon or fintech challenge, etc., banks were, of course, organizing these. And one of the motivations for organizing these was to show to the world that they were being innovative. However, the situation for the fintechs was that if you won one of these challenges or competitions, you would actually start to run out of money, because the bank would then get interested in setting up a partnership with you. But the process was so slow, and everything would just take so long that, and the bank would require to give all your attention to them, that you would actually run out of money before you had a contract to sign, which is illustrated in this code here. Winning a fintech challenge is a sure way to run out of money. What this means is that when you look at big banks, established banks, and their response to open banking and PSD2, what we see is that a lot of them are investing into fintechs, but independently, meaning they don't integrate those services into their portfolio. And they have started to provide account aggregation services, because that is a way for them to actually amplify their data. Meaning, if I'm in the HSBC app, but if I have a mortgage from Lloyds, then I am able to see my mortgage from Lloyds in HSBC, and most of the banks provide this. However, going beyond this has not been possible for banks for the reasons indicated above. Now, if you can't make something, typically you would try to buy it. And banks also have had the choice of, buying platforms, ready-made platforms. And there were some fintechs, for example, Bud and Token are some names that are quite familiar to some. And white label them so that, from the consumer's eyes, this looked like, oh, HSBC provides all these additional services. The problem with that is that when you bought a platform like that, you had to then, rely on the platform provider to tell you whether you can just put all the fintechs that you want there of your choice, or whether it's a ready-made basket, let's say, with 4 apples and 5 oranges that you cannot change. And here I provide the spectrum, but interestingly, the platforms that banks decided to go for, which is 2 out of 9 banks decided to do this, they all went for the build your own platform, meaning I choose which fintechs I'm going to put on this platform. And as you see here, this is dangerous, because all of them then chose fintechs that did not compete with their own products and services, meaning the platform actually has some additional services, but it doesn't require the bank to be more innovative in their existing products and services. So again, this is, yes, in terms of platform formation, this ticks the box, but in terms of platform openness, it is actually quite problematic. Now, very briefly over to challenger banks. The challenger banks also provide platforms, and let me show you a few examples. This is from one of them. They provide Amazon or eBay-like marketplaces where you can shop for all these financial services from different fintechs. The problem here is quite different, though, when you're a challenger bank. The problem is one of customer acquisition. Customer acquisition, when you are in a regulated and data-sensitive industry, is already difficult. And what we see is that PSD2 and open banking, on the one hand, help in the sense that you can try services from Monzo or N26 without really switching away from your bank, which, as Oscar mentioned, is something that a lot of us are much less willing to do compared to getting divorced. The problem is that many people then opened these accounts but didn't put much money in them because they didn't have the trust. That meant that these guys were increasing their subscription numbers, but the actual money coming in was quite low, which meant that they could not break even. And in fact, still today, there's only one that is breaking even, which is Revolut. What were some of the solutions that they thought of? A lot of them actually gave up, and they decided to go from, going directly to the consumer to becoming a kind of a white labeled platform, to just like the one I mentioned, but BUD. They started as a challenger bank, but they quickly realized that it was very difficult to grow in that sector, and therefore decided to go and become white labeled. Some of them went to energy firms and said, why don't we build a cross-sector platform? This was an interesting proposition. However, as soon as they went to energy providers, they realized that if banks were archaic businesses, energy providers were even more so, which meant that trying to integrate data services with energy was quite problematic and led to many system failures. Some of them, as you see, N26 and Revolut, for example, they have all gone international. The problem with this is that many of the services that they provide are quite reliant on local regulations, such as pensions and investments and taxes, etc. And so this means that every time they enter a country, they actually have to operate completely new and in compliance with those new regulations, which means that this is a very slow process. Now, in the interest of time, I'm going to skip one slide, and I'm going to bring you to something that has just been discussed in the previous presentation, which is the role of big tech or GAFA platforms. If you look at this, in terms of platform openness versus platform formation, we see that fintech startup on the right side up there actually provide great services in terms of cheap, user-friendly services, but the customers don't trust them, and therefore these guys have difficulty growing in terms of numbers and in terms of money. Incumbent banks, on the other hand, on the right lower corner, they have the trusted brands and the resources, but because of their IT and cultural infrastructure and the regulatory unevenness, they have not been able to provide open and innovative, competitive platforms. When you shift to the left lower corner, you see incumbents trying to buy these platforms from the market, which is great because you have the brand of HSBC, but then you have a fast offering. But the problem is that even when you buy this platform, if you then don't put attractive products on it and you always try to push your own products, then you don't provide an attractive offering to the customer. Which brings us to the left upper corner. And here we see that the likes of Amazon and Google and Apple have the trusted brand. And because these platforms to buy already exist in the market, they can quickly enter the market by getting these platforms to buy. And because they don't have their own products and services in finance, this is not in conflict with their strategy. And given that both fintechs and incumbents are startup fintechs and incumbents are struggling, there's a huge opportunity for GAFA firms to enter the market and to start to make money in finance. And to that point, we see Google working on, to provide current accounts. Apple is providing credit cards, and we have Libra here in the corner, which is not going well. However, something else that's going well is that Facebook is actually using their platform in social networks in order to integrate messenger payments. And especially in developing countries where Facebook is quite dominant, this ends up being one of the primary ways in which people pay one another, both in business and in other terms, right? And Amazon is doing SME lending and very much trying to strengthen their retail platform position by providing financial products to users and providers on that platform. What does this mean? This means that, there are turf wars between firms, meaning incumbents and fintechs that keep platforms from emerging. But it's not just about the power struggles here, but it's also that the IT infrastructure and the regulation that has, been the most important thing for incumbent banks for many decades has made it difficult for them to now adjust to this new world, and there's no perfect solution to it. And in a sense, an unintended consequence of PSD2 and open banking has been that regulators try to open up the market to newcomers, but because of the nature of the market, startup firms really struggle here, which means that big tech platforms have now an easy entry to come in and play against big banks. This concludes my presentation. This is just for my information for if you want to connect afterwards, and I'm looking forward to the discussion and the questions. Thank you.
Thank you very much, Pinar. It's now Joe McCahery's turn to take the floor.
Well, Joe McCahery, I'm from Tilburg, and I'm discussing this excellent paper that we've just heard. Let's start with the objectives. I think, first of all, the paper itself is very innovative in the sense that it brings together strategies and challenges. It looks at these trade-offs between incumbent firms, as we've heard, as well as challengers. And it looks across, an important element, the cultural, technical, and then the degree of openness. So the focus is on platform formation, as we've seen, the organizational challenges for both startups and incumbent banks, and then other contributions that we've seen. So how does this paper fit into the literature? First of all, it's clear that it fits into the regulatory industry's literature because we're looking at specific effects on platforms, and those are well documented from the interviews. The second point is very clear, which is the impact on platforms on industry disruption. We've seen that that's something that's been recently done in the area of banking, but in other areas, and the paper mentions the extension to health and other important regulated industries. And of course, open banking regulation in Europe. So in fact, there's three areas of key contributions that this paper's made. In terms of looking at the contribution itself, I think the most important contribution is the impact of the trade-offs facing incumbent and new firms during this transition period. It's unique in the sense that it looks at these challenges by comparing and contrasting the efforts we've just seen in an environment, and this is the key thing about platforms and the regulation that's been developed, highly regulated data-intensive banking industry in the UK. So indeed, it's unique in that respect. And the key thing, of course, is the method, which are semi-structured interviews, looking at both types of firms, regulators and industry participants during the so-called period between 2016 and 18. So we have a very clear period when there's an announcement, the implementation, and then the afterward effect. So in terms of where it relates to the literature, well, it's clear on the one hand, the shift of businesses in the banking segment to platforms. We've seen earlier work on that. And then the ecosystem or the environment in which it operates and what the overall effect is. So the takeaway, at least in terms of summarizing the firm paper in terms of its contribution, is showing the effects, the technical cultural effects in terms of trade-offs between the two types of firms, and then measuring as a response or in relationship to the degree of openness with respect to the decisions made. So that's the overall contribution, which is significant, I believe, and an important paper. In terms of the paper's approach, first of all, the theoretical approach is the account of the transitions to platform businesses. The model, of course, is the platform model that was discussed at the initial part of the paper. And the key point here, what's introduced, are these trade-offs in terms of cultural and technical. Nice thing about linking the theoretical insight is to the empirical semi-structured interviews. We have 79 interviews from the period in question, and the investigation that is on the degree of platform formation or participation, and it's linked very tightly to the theory offered. Okay. My first comment is one thing that's important with respect to both types of firms is the issue of cybersecurity threats and liability. So what came up, at least in terms of comments, oh, sorry, there was some slides missing. The first comment is the nature of the interviews and questioning. The one I had in the first part was there's probably still some bias, notwithstanding the attempts to limit the biasing of the overall questioning with respect, for example, to cross-examination. There might be some issues about accuracy and assumptions and obviously the effectiveness of that type of method. Event tracking, there's questions still about organizational and behavioral factors, creating bias. And finally, in terms of non-direct questioning, the tailored response concerns that someone might have with respect to the expectations of the answer that would be given. So there's a real question about, is it possible that there's some residual bias still in the nature of the semi-structured questioning methodology that's been used by the authors of this paper? That's the first comment. I think there's probably not so much. I think the authors did a great deal to limit that, but it's some issue that could still raise a concern. The second question deals with, maybe an undisclosed or not fully major concern was one of cybersecurity threats and liabilities. I think if you look at the trade-offs, it's certainly one that creates a defensive mentality for the incumbent banks, and certainly in terms of consumers will deter those end users from signing up. So we see more and more of the defensive mentality with respect to incumbent banks. They put so much in cybersecurity defenses, and the interesting thing with respect to the cybersecurity defenses that the fintech firms are the ones who have been the most innovative in the area of designing cybersecurity defenses. So in that respect, the big challenge for the incumbent banks has been illegal reputational risk as a consequence of cybersecurity risk versus the so-called newer firms that may not have much in the way of reputation yet, but perhaps have the technology, notwithstanding the loss in the race to actually win over the most customers for their own self-standing banks as a consequence. So the second point is cybersecurity threats. What's the impact for both types of banks? So my comment now might be, where can I add value? I think there's been an impressive analysis, at least from the interviews, on what the trade-offs are culturally, technically, and a degree toward openness with respect to the two types of banks. So the question might be, what's missing or what could be added to this paper? Well, I thought maybe we need a second instrument. The paper itself is qualitative in terms of the instrument used, semi-structured interviews. I've mentioned perhaps there's some residual bias. There's no plan with respect to having a second type of instrument. So I thought maybe two types of instruments could be used in this study, or at least one considered. One, perhaps an event study. That is to say, if we could look at the implementation or the announcement of PSD2 with respect to what the impact would be on the banks in question, that is to say, the banks that were affected by the regulation, so we could actually do a range of windows from the announcement, the enactment, and implementation. And what from that instrument, in terms of the data that could be accomplished from receiving it, we would have some type of instrument or mechanism to look what the impact would be for people involved, that is banks in the European payment chain. We get a sense, particularly if we did it not just UK banks, but banks from neighbor countries, to see what the anticipated market effect would be with respect to the changes that would be forced upon or made by those banks in response to the regulation. So perhaps an event study as a second instrument to complement the semi-structured interviews would give us a different view, at least on how the market viewed one set of banks, that is to say the incumbent banks, and the consequent effects on them. Notwithstanding that as being at least a partial explanation or a partial way to deal with the second method issue, I thought perhaps if an event study was not in the opening set for the authors, we could look at a survey. A survey might be useful in the sense that it could be devoted to determining the effects of the characteristics of the CEOs, the business characteristics of the firm, their service characteristics, and what the overall effect would be on the platform decision-making for both types of firms. And the survey questions could go to the focus of service, the ease of usage, accessibility, size of transaction services, portfolios that the firms have, to give us a real sense of what the actual so-called independent and dependent variable would be. So here we're looking at, let's say, the degree of so-called movement toward services on a platform, and then looking at these other variables such as business characteristics, service level, and environment such as regulation. So in that respect, we would have an idea that the survey would give us a different type of understanding vis-a-vis the one we have from the qualitative interviews. So if we take them together, the paper would have both a qualitative and a quantitative instrument, giving us a unique view of what the actual challenges are for both types of firms. So what's the takeaway for this paper? First, it's a very interesting paper. It's a unique paper in terms of the methodology, but also the result, which is suggestive and significant. I like the approach of studying technical and cultural trade-offs. I think that's innovative. And the consequences, of course, which the authors make very clear, and for both types of firms to see what the real choices were and how effective they were with respect to the regulation and how they actually channeled their activities as a consequence. I also think from a corporate finance and strategy perspective, this is a very interesting avenue of research. At the end of the paper, I think the authors make it very clear that there's more extensions that can be built from this model, and I think the model is very important. I think in terms of making or extending the model, some more quantitative work from, let's say, an event study or at least something from a survey would enhance the paper, which is already very strong and I think merit-worthy. So I enjoyed reading the paper and commenting on it today.
Many thanks, Joe, for the excellent discussion. I would give the floor to Pinar if she wants to reply.
Yes, thank you very much, Joe. This was very helpful, and I am very glad that you liked the paper. Now, in terms of the specific points, let me quickly just say that one of the strengths of the paper is that because we were talking to many of the players that either worked with one another or currently try to work with one another, we had quite a bit of triangulation of what was going on. So the banks, incumbent banks perspective didn't just come from the bank employees, but also from former employees and fintechs that try to work with them and regulators, etc. So there's a great deal of triangulation going on in terms of the data. In addition, we try to, of course, work with reducing retrospective biases by, making in the interviews, make them focus on facts and, understanding all the kind of factual information that was around an event that they described. So we took a bunch of measures in order to make sure that, and also, of course, the longitudinal nature of the study helps in making sure that these changes are tracked in real time. Interestingly, about cybersecurity and system resilience, in a sense, we noticed too, and this may be good to mention in the paper, maybe, that we noticed two types of threats. One of the types was the regular, every kind of bank, small or large, faces this, is the cybersecurity threat coming from outside. And here we saw that large banks were actually quite, worried and spending a lot of resources on this. And smaller banks, because they were resource strapped, had more difficulties in dealing with this issue. On the other hand, because in the sense that security and system resilience was also an issue when you were updating the system yourself, here the new banks had much more advantage because these were built on newer technologies, and they are actually the technical guys that build these platforms, and so the platforms are technologically quite advanced. And here we saw the incumbents struggle much more compared to the newcomers. I love your idea of introducing, let's say, a quantitative component to this. And also, independent of whether we do quantitative or not, I also really like the idea of dividing it into periods and saying this is the announcement part, this is the transition period, and then the implementation period. I think this is a very good way to provide more structure into the paper and maybe bring out the longitudinal side of it. We are looking into the announcements made by these firms now, but how we can measure that in a way that helps the findings of the paper is something that we are now looking at. Whether there are, can we actually avoid going to the customers, because then it starts to become a really unmanageably big study. We thought about surveys. One of the issues with surveys is that surveys are very easy to do with smaller firms, the fintechs and the challenger banks, and to a certain extent, consultants, etc. But regulators and incumbent banks, which provide at least half of the data that we have, they don't fill these things out, and especially telling HSBC to let their employees fill out the survey, which really goes to the competitive and kind of sensitive issues that they deal with and they try to manage internally. This is one of the hurdles. So this is why we think that if we do a survey, in a sense, it would have to be a customer survey, because if we do it on the firms themselves, it would only be half done. The other half would just be meaningless or not complete. So yes, these are my comments, but I thank you for your suggestions, and we are now working to improve this paper, maybe do one more iteration and then send it to a journal. So these are very timely and helpful. Thanks.